when you have a set of contracts pulled up, you should be able to see this. And essentially what this is you see that purple line. The purple line represents what I call fair value behind a contract. And depending on the contract or that stock, how many people are trading those contracts, how much volume, open interest, what do the spreads look like, that is going to influence what the price of that contract is going to be. Now, the weird thing was I saw that when the order hit the software yesterday on CAVA, by the way, that was 241 grand behind that order, the fill was at 142. $142 per contract. Now, when I pulled up that specific contract, I saw like 150 to 3, like a 50% pretty much spread. And I'm like, wait, what? How is the spread at 150? How are we up there at 3 if this guy just got filled at 142, right? Or whatever it was exactly. And so they were just priced in really weird. If you think about it from the perspective of when these orders come in and hit the software, there's going to be this huge influx in obviously that volume, and wherever that buyer got filled, it's going to create this like almost vacuum. And so it's often smart with a lot of these contracts we trade to just give it a second after the order comes in on the software or after I post the actual call out to then let the spread kind of dictate itself. Watch the spread for a minute and see where those contracts are pricing in fair value. And again, you could see that based off of the purple line. And you could see how in that screenshot, we were trading up at 3 for just 1 second. This giant red candle, someone got filled up there at 3, right? And then pretty much, immediately almost came back down to fair value behind this contract. So just be very careful, especially right now when you're going to enter a trade. Don't even try to analyze the purple line and know what's going on with that. I wouldn't even say that's necessary. I would say give it a second, watch the contracts, look at the bid, the mid, the ask, right? Look at that spread, look at the difference between where buyers are looking to buy at, where sellers are looking to sell at. And if the mid kind of point doesn't really make sense, which it wouldn't have yesterday, and I could see that by looking at this, just wait and see where orders are coming through on the tape. You guys have obviously the setup there on my TOS, and we can see orders hitting the tape. We know exactly, what orders are coming in, when, where, how much, right? We can see that under volume, right? So this is right now. I mean, it's funny, those CAVA contracts are up 700% today. Obviously, we can see that, there's some people trying to buy here at 350. We've got some buyers at 365. If you see a buyer way up here at 510 or a seller, maybe you could tell that's just a bit of spread manipulation. So even if I was to put out an order really, really high on the buy side, that would fluctuate the spread. And if there's not a lot of people trading those contracts, there's not a lot of volume on those contracts, not a lot of open interest, well, I could pretty much skew the spread and make it seem like if you're in the trade already that you're up a ton, or if you're trying to get in that's a price to buy at, because that's where I'm looking to sell at. So just be careful when you go to enter the order. Does that make sense? I want to talk more about that and go into a little more detail and use some more examples, but as just a quick, be careful right now during the market, during these market conditions. I would just be aware of that. I don't really trust the spreads right now. Whenever I see the order come in on the software, I normally reference what their actual buy-in was. And so if you're following the call out, you can reference what my buy-in was. So yesterday, hopefully you're okay, he got filled at 142. There's no way these contracts have moved to 3. So $142 to $300 in a couple seconds. This stock hasn't moved at all. So that's someone, again, putting a really, really high order in, a really high sell. They just have a limit order sitting there. They have a limit order sitting there. They're looking to make 100+% on those contracts. You can pay to buy those contracts and you could get absolutely killed because someone wants to sell them. It's like if you go on Facebook Marketplace and you see someone's offering something and you just don't realize that it's a terrible deal, and you still go because you don't realize it's a terrible deal and you buy those contracts. Well, now you just overpaid or whatever you bought, right, on Marketplace. Now you just overpaid 100% what the actual market value is of that, you know, that computer you bought on Marketplace, and you're stuck with it. You just paid way more. You paid 100% more than it's actually worth because someone was offering it for that price and you didn't do your research to make sure that that was a fair value. So that's the same thing that it's happening in the options world. It's happening every time you go to place an order. There's people trying to rip you off that have really, really high orders that if you fall for it, like you could get filled at that, you know, 100x what the, or 100% what the actual fair value of that contract is. Does that make sense?